Hello and welcome to my channel. In this video, we would be covering the topic Important Trade Documents. This video is part of playlist uploaded on International Trade Finance, where I have already uploaded many other videos related to ICC, Incoterms, payment methods. So do watch the playlist so that you can get a broader understanding about this subject. You can get the link to the playlist on the I button in the description as well as at the end of this video. Let's start with this one. If you like the video, do hit the like button and please subscribe to my channel for more videos on banking, finance and management. Now let's start with this one. So we have already covered what exactly is international trade finance, how does it work, what all payment methods are involved, and in my last video we also discussed about this documentary collection method, where we saw that how documents are serving a very important purpose. Now let me make this simpler for you to understand. So we are talking about a marketplace where there is a seller and a buyer. Now imagine this at the global level, so at international level. So the seller is exporter and the buyer is the importer. Now there is trade transaction happening between the importer and the exporter, or the buyer or the seller. Now because they are located in different countries, and we know that the goods to be shipped from one country to another country will take a lot of time. So how should the buyer be assured that the goods that are coming is proper or not? How should the seller be assured that buyer would be making the payment once they would be receiving the goods or not? So there are certain risk involved, there are certain uncertainties involved. In all these things, we know there are different guidelines issued by ICC which is serving the purpose. But we are talking about documents which is playing a major role in all these transactions. So these trade documents, they are serving as proof of transaction or action being done. So, if certain goods are being shipped from one country to another country or to destination country, so there should be certain proof in written form, so that the buyer or the bank and financial institutions which are involved in the transaction, they should be assured that these goods are shipped, this particular is the quantity of the goods, how much is the payment involved. So there should be some documentary proof involved, because anyways it would be taking a long time for goods to reach from one place to another place. Till then there should be certain evidence. So these trade finance documents are serving as an evidence to the whole transaction which is being carried at international level. So starting with the transport document. Now transport document prove that goods have been dispatched or transported by a particular mode. So it may be through sea, it may be by air, or it may be multimodal transport where seaway, airway as well as this roadway is also involved. So transport document is giving a proof that the goods have been dispatched from one country to the destination country. Similarly, then there is commercial invoice. Invoice is what we do when we go to market. We buy certain thing, the seller gives us a receipt or invoice which mentions that this particular amount has to be paid. So the same thing is commercial invoice. Commercial invoice is raised by the seller to the buyer. Here in terms of international trade finance, it is the seller is exporter, the buyer is importer. So it is an invoice raised by exporter to the importer, that is commercial invoice. Then there is certificate of origin. Certificate of origin is a proof that goods have been originated from a particular country. Now there are certain countries where some of the countries may not be having good relations with certain countries and they don't want to do transactions. So they want to know that where exactly is the good coming from. Is it according to the trade agreement? Is it according to the contract set between the seller and the buyer? So it's very important, the origin of the goods. So certificate of origin provides a proof that the goods have been originated from particular country. Then there is this inspection certificate. It shows that goods have been inspected by third party or agency and it meets certain standard. Insurance certificate, it certifies that goods transported are insured and the risk involved is covered. Then there is bill of exchange. Bill of exchange serves as a demand of payment by seller to buyer. Then there is packing list. Then there is packing list, which shows that what exactly is the good in terms of quantity, weight and measurement. So these are the important trade documents which are involved in this international trade transaction. We would be covering one by one all these documents and we will see how important it is. And till now, let me summarize this whole thing that we just now discussed. So trade finance documents are serving as a proof of evidence that certain action is being done. Seller and buyer involved, as well as other banks or financial institution involved, should ensure that these documents are according to the guidelines as per international trade transactions. Every document is serving certain purpose. They are providing certain proof. For example, transport is proving that goods are dispatched. For example, invoice is proving that this much amount is to be paid. For example, certificate of origin is proving that the goods are originated from certain country. So these all trade finance documents are proving something, are working as an evidence, because the risk involved at international level, where the buyer and seller located at different countries are having certain uncertainties, and then they should be assured of action being carried. Now let's move to our second slide, which is about bill of exchange. Bill of exchange is a draft made as demand for payment issued by the exporter or drawer to the importer or drawee. So bill of exchange is a demand document. It is raised by seller to the buyer to pay certain sum of money in future. Okay, again I am repeating. See, don't get confused with names. Exporter is referred as drawer when we are talking about this bill of exchange. Importer is referred as drawee. Exactly, they are the seller and the buyer. There would be other parties also involved, which is called as payee or the holder. I would be explaining that. Okay. So first you try to understand that bill of exchange is a written document. It is a kind of demand document where the seller who has sold the goods to the buyer is making demand from the buyer to pay certain sum of money in future date. Okay, this is all about the bill of exchange. These things would be mentioned. Now, who is the drawer? Drawer is the person who would be preparing the bill, the seller or the exporter. Drawee is the person who would be paying the bill, the buyer or the importer. Then there can be other parties involved, the payee, person to whom payment is to be made. So maybe the payee or the drawer are the same person, the seller, and the payment has to be made to the seller. Maybe the seller wants the payment to be made to some other party. So he would be instructing the buyer that, see, I don't want the payment to myself. You please pay to my vendor, because anyways I have to pay back to my vendor. So you directly pay to my vendor. So there can be third party involved who can be named as payee, person to whom payment is to be made. Then there can be holder of the bill, the person who is taking the possession of the bill. Okay, so drawer, drawee, payee and the holder. Drawer is person who is preparing the bill. Drawee is person who would be paying the bill. Payee is the person to whom the payment, actually the payment should be going to. Holder is the person who would be having the possession of the bill meanwhile in between the transaction. What exactly is bill of exchange? It is a written demand document raised by seller to the buyer. Now let's see. BOE are normally issued in a set of two, first of exchange and second of exchange. This is how it is referred to. So because we call it as bill of exchange, it is when it is issued in set of two, we refer it as first of exchange and second of exchange. The tenor of a bill of exchange shows when the payment is due. It can be either at sight or usance. I already have discussed about sight bill and usance bill in my previous video. Again, I am repeating that sight or usance bill you can understand in simple way as cash or credit. So when you go to buy something, you just buy that good and you make cash payment. That is sight payment. If you go to buy something, you buy that good and you tell the seller that I will be making the payment after 30 days. Right now I am not having money. You please give me this good at credit. I will be making payment after 30 days. You can raise the invoice for me and write it over there that after 30 days I am obliged to make this payment. So the seller would be raising the invoice on credit terms and the buyer would have to make the payment. So that would be referred as usance. So this is at sight means instantly. You made the payment once you received the good. Usance is after certain period. In future date you have made the payment. Even after receiving the good there was certain time gap involved. At sight, bill is payable on demand instantly as soon as buyer receives the same, while usance bill is payable at the end of a predetermined tenure. And usually in international trade transaction, it goes like in multiple of this 30. So 30, 60, 90 days. This is the usual usance period on which the bill is raised. So what does this mean? If the bill of exchange would be mentioning that this bill need to be paid after 30 days from the date of acceptance. Date of acceptance means on the date at which the buyer received the goods and accepted the bill, from that day 30 days more would be allotted to him to make the payment. Okay, so this is how it would be mentioned. Serves as an unconditional order in writing mentioning certain sum of money signed by the drawer. So till now you must have understand that bill of exchange need to have certain things mentioned so that you can recognize that a particular document is a bill of exchange. So it would be mentioning the payment term, whether the payment has to be made on site or usance. It would be mentioning the amount, as we discussed that it is a demand by the seller to the buyer. So it would be mentioning what is the amount that needs to be paid. It would be mentioning the name of the drawer, the name of the drawee. It would be signed. And so these are certain things which are really important and which would be mentioned there in the bill of exchange document. Moving to our another trade document, which is commercial invoice. It states the amount payable as agreed between the importer and exporter. So we took a simple example of being a buyer and seller in a particular market where we purchase certain good and seller will be raising invoice mentioning the amount, what good we have purchased and at what date we have to make the payment. The same thing is referred as commercial invoice in international trade transaction. So here the commercial invoice will be raised by the exporter or the seller to the importer or the buyer, mentioning the amount payable, that what amount need to be paid as agreed. So as per agreement or contract between the buyer and seller regarding the quantity of the goods that are involved in this particular transaction. So commercial invoice will also be mentioning the goods that are being shipped and will be listing the unit prices. Unit prices, what does it mean? So commercial invoices would not only mention the cumulative amount. For example, 1 lakh is the price of the good that is being sold. So 1 lakh need to be paid. No, it should not be mentioning like this. How many quantity of goods are being shipped? What is per unit price? So if 50 kg of something is going from one country to another, what is the price per kg? And then what is the cumulative price? So it would be listing the unit price and the cumulative price. It would be describing what are the goods being shipped from one location to another. So it would be mentioning the amount as per the agreement. Let's see, it is issued by the exporter and addressed to the importer. Here it is mentioning as beneficiary and applicant. Please don't get confused with different names. It is as per letter of credit. I would be covering documentary credit in my next video where it would be made clear to you that why exporter is referred as beneficiary, why importer is referred as applicant. These are different names involved as per the transactions. Now, in simple way, I'll try to make you understand about LC and why in many of the slides you will be seeing that as per documentary credit or as per letter of credit. because buyer goes and ask the bank to issue LC in favor of seller. Sometimes seller cannot trust the buyer that whether the buyer will be making the payment after receiving the good or not. So in that case, buyer will go to bank and will ask you, please provide me or issue an LC that would be mentioning that I would be making the payment to the seller after certain days. So what bank does, it would be issuing a letter of credit, and because bank is involved and they are taking the responsibility that in case the buyer will not be making the payment, I am the one who is responsible and we will be making the payment as bank to the seller. So the seller gets the assurance that even if the buyer defaults, bank has took the responsibility of making the payment if everything is as per the LC terms and conditions. And this is why documents plays an important role in letter of credit. When I say as per LC terms and conditions, so there can be many terms and conditions involved. For example, this commercial invoice should be issued in 3 originals. So only when there will be 3 originals provided and dispatched to the buyer from the seller, it would be as per LC terms and conditions. So LC would be mentioning certain things that need to be complied with, and then only the buyer will be making the payment or the bank will be taking the responsibility. And this is, I think, in brief, you can get the understanding why documents involved in trade transaction are also so important. And when we would be covering the video on letter of credit or documentary credit, the things would be more clear that according to LC, these documents should be in a certain proper format, uh, complying with certain guidelines which are there in force related to international trade. It should be issued in certain originals and certain number of copies, and if anything is found discrepant or not complying with the terms and conditions, it needs to be amended, or the responsibilities need to be fulfilled. Okay, so that's why it becomes very important that every document should be in properly checked, and should comply with the guidelines, should comply with the LC's terms and conditions. Now we were talking about, coming back, we were talking about commercial invoice. Sorry for this. We were talking about commercial invoice. So you need to notice certain things, that commercial invoice will be mentioning the invoice number and date. The country of origin and destination will also be mentioned. The description of goods will be given, that what all goods are being shipped, and the price obviously would be mentioned, because commercial invoice is a proof that certain amount need to be paid by the buyer to the seller as per the contract. So unit prices will be mentioned, cumulative price would be mentioned, parties names would be mentioned that are involved. It must be signed also. Okay, let's see. In documentary credit transaction, it must be consistent as stated in letter of credit and must be issued as stated. I have given a brief idea about letter of credit in my next video, when I would be uploading the video on LC or documentary credit. These things would be more clear to you. So for now, this is all about commercial invoice. Now we will be moving to our next important trade document, which is transport documents. Bill of lading. A bill of lading is a legal document or receipt issued by a carrier or transportation company to a shipper for carriage of goods by sea. Parties on a bill of lading are shipper, consignee, notified party, and carrier. So we already discussed that transport document serves as a proof or evidence that transportation is being done. The goods are being carried from one country to the destination country. The goods are being loaded. It will be dispatched. What all are the goods? The description will be mentioned. So transport documents, it can also be, the transportation can also be through the way of sea. It can be through airway, and somewhat it can be multimodal transportation also, where seaway is also involved, roadways are involved, airway is involved. So it can also be multimodal transport. Here we are covering bill of lading. Bill of lading is a proof that goods are being carried by sea. Okay, goods are going through the route of sea. So whenever the goods are being shipped through receiving, this document would be issued by the carrier or the transportation company, which is referred as bill of lading. Now, certain things would be mentioned in a bill of lading from which you can get an idea, okay, that this particular document is a bill of lading. So, it would be BL number, the carrier name would be mentioned, the shipper, the consignee, the notified party name would be mentioned, the description of goods would be given, from where the goods are being originated and where exactly the goods are being dispatched to. So, the country of origin and the country of destination would be mentioned. The terms of payment would be described. Then it would also mention about freight. So let's first discuss about the parties that are involved in bill of lading, which I have mentioned over here. The first one is shipper. So shipper is the person who is sending the good. It can be the exporter and the order seller. Okay. So shipper is the person who sends the good. Second is consignee. Consignee is the person who takes the delivery of the goods. Consignee may be different from the buyer or the importer. It may be same also. So consignee is the person who is taking the delivery of the good. Notified party. Notified party is the person, it is usually the importer to whom the shipping company is giving notice of arrival of the goods. So once the goods will be arriving in the destination country, the shipping company or the carrier would be notifying the party, the importer, that the goods have come. So this is referred as notified party. And then there is carrier. Carrier is the company, the shipping company who has concluded a contract with the shipper or the exporter for the transportation of the goods or the conveyance of the goods. Okay, so is it clear now? Shipper is one who is sending the goods. Consignee is one who would be receiving or taking the delivery of the goods. Notified party is the one to whom the carrier, the shipping company, gives a notification that the goods have arrived in the destination country to collect the goods. Carrier is the shipping country who has made a contract with the shipper or the exporter about the transportation of the goods. Now see, BL is a negotiable document and goods only get released against surrender of a signed original of bill of lading. Now this is very important, and that's why BL or transport documents carry huge importance in trade transaction, because the goods, after reaching the destination country or the importer's location, it would be there at custom, and if the buyer or the importer needs to get the custom clearance, it would have to present the original bill of lading that he or she or that the buyer has received from the seller. So what exactly happens in the whole process? That the goods are shipped by the seller to the buyer. It would take certain days for the goods to reach from one country to another country. Till then, the shipper, the exporter, makes the document in which transport document is also involved. So it makes a set of the documents that these goods are being dispatched. Here is the proof of the transportation being done. Now that documents would be sent through bank to the importer. Importer would receive the document. In that document, bill of lading is also there. So bill of lading, after the buyer has received the bill of lading, it can go to the custom, it can give the original of the bill of lading and get the goods released. Unless until the importer has not provided the original bill of lading, the goods will not get released. And this is why this transport document or the documents involved in the trade transaction carry so much importance. Again, I also mentioned about that these documents are carrying a huge importance in LC transactions as well, and LC defines certain terms and conditions. According to that, most usually you will see that bill of lading are issued in a set of 2 or 3 originals. It must be signed by the shipping company or the agent. Report of loading and discharge would be stated. Good descriptions, weights, shipping marks must be consistent with that shown on other documents. And now this is applicable for every other documents. So whether we are talking about packing list, inspection certificate, insurance certificate, certificate of origin, transport document, bill bill of exchange, commercial invoice, all the documents should be consistent with each other. So it can't happen that in one document the party name is something different, in another document the party name has changed, in one document the country of origin is something different, in another document it is different. It would be inconsistent and invalid. So in all the documents, consistency should be there so that the genuineness of the transaction can be proved. It must show whether freight has been paid or is payable at destination. So freight is the amount paid for carrying the goods to the carrier or the shipping company. So it also should be reflecting that whether the freight has already been paid by the seller or will it be payable at the destination, and the responsibilities would be defined as per Incoterms. I have already covered one video on Incoterms where we saw that who would be taking the responsibility of freight, who would be taking the responsibility of insurance, and there in the agreement or the contract between the buyer and seller, this is pre-decided that what would be the Incoterms in place, what would be the roles and responsibilities of the seller and buyer. If the freight has to be paid, whether it would be paid by the seller or whether it would be paid by the buyer, who would be taking the responsibility. Okay, so this would also be mentioned in the transport document, whether freight has been paid or will be payable at the destination. Airway bill. This is a receipt of goods being shipped from an airline company. Just let us read out these points. It's similar to bill of lading. The only difference is that in case of bill of lading, the goods were being shipped through the sea mode. Here the goods are being shipped from an airline company. So shipper and consignee name must be shown in the airway bill. The airports of departure and destination must be shown. Flight number and date should be shown. Goods description must be consistent with other documents. It must show whether freight has been paid or is payable at destination. Now let's come to other two documents, which is packing list and certificate of origin. So packing list content of each crate, parcel, etc. showing packing material used and shipping marks affixed on the outside. Measurement and weights of good is mentioned. Description of the good should be consistent with the other documents. So as I said that this would imply with all the documents that whatever description is being given, it should be consistent with each document. Now packing list should also specify that what packing material is being used, what is the measurement and weight of the goods, and as I mentioned that packing list is giving an idea about that particular goods in particular quantity is being shipped from one country to another. Second is certificate of origin. Certificate of origin is a proof that the goods are being originated from a particular country. So many of the details would be mentioned, would be same in each trade documents, but each trade document is having certain specification in it. So for example, bill of lading was a transportation proof. Packing list is a proof about the goods or the description of the goods. Commercial invoice was a proof of the bill being raised. Bill of exchange was again a demand for payment. Similarly, certificate of origin is a proof that the goods are being originated from a particular country. Now it shows details such as consignor, buyer, goods description, package details, weight and country of origin. So the last one which we are covering is insurance and inspection certificate. Insurance policy or certificate provides actionable evidence of a contract of insurance and shows full details of risk covered for shipment. Now see, why is insurance important? So goods are being shipped from one destination to another destination. There may be many risks involved. Maybe the goods would be damaged while in transit. Maybe the goods were not able to reach the destination. Maybe the goods was not as per the terms and conditions. Maybe something misfortunate happened in between the journey and the goods were not in the same condition. So there can be many risks that can be occurred while the goods are in transit and not have reached the destination country. So that's why the insurance is important to cover the risk, and because the transaction amount would be involved would be huge, so insurance becomes more important so that the loss can be minimized. So it acts as a proof that the goods that are being transported are insured and the risk is covered. Now, what all things would be mentioned in an insurance certificate? Insurance value would be mentioned, claim amount, who would be settling the claim, so the claim settling agent or the insurance company, place from where the insurance would commence or start. So the port of loading, usually it is from the port of loading to the port of destination. So all these things would be mentioned in the insurance certificate. Coming to the last one, which is inspection certificate, the importer requires the consignment to be inspected by a third party at the port of shipment or warehouse before the goods are sealed and transported. So seller does it on the requirement of the buyer that the goods that are being shipped should be inspected by a third party before it leaves the warehouse, and that's what is presented in a form of inspection certificate. Thank you for watching this video. I hope this video would be useful. Thank you so much.